Good evening, folks. Welcome to TalkGunStopTrading.com. This video is for Wednesday, February 12th, 2014. All right, folks, let's get into the action today. Market was basically flat. S&P is up 9 cents. The Dow Jones was down 31 points, and I believe the Russell was up about 4 points, give or take a couple cents. So basically, I'll call it a flat session, even though the indices were basically up except for the Dow. Well, yeah, except for the Dow was down 31 points. So, and light volume today. Right now, I got the daily chart up with the spiders. We traded 94 million shares, so pretty light volume. As you can see, we pointed out yesterday, this light volume move up portends lack of institutional participation, and when the institutions aren't participating, this rally lacks some confidence, if you will, or conviction is the word I'm looking for. So I expect this market to at least pull back before it goes higher, possibly, or pull back even steeper where you get more of a sell-off. In that case, if you get a sell-off, more steeper sell-off and a sideways consolidation, it could go lower after that. But in any case, depends on what angle you're coming in at. If it's a slight pullback, then it's setting up to go higher. If it's a steeper pullback, we'll have to reevaluate that. Yeah, either way. But again, what we expected, and to be honest with you, we are coming in some weakness, and I expect some sort of weakness. How severe, what the magnitude is going to be, I do not know yet. We'll just have to wait for the market to tell us. Wait for the tape. The tail of the tape to tell the story. Again, I can't predict the future. I can only tell you what the charts are telling me, or how I'm reading the charts, or interpreting the charts. And remember, these charts are just human emotions. These are traders' emotions and institutional emotions playing out with fear and greed and fear. That's all it is. And this is a chart of the consensus of emotions there of the players in the market. And the candlestick patterns tell a great deal about emotions and what the next move may be. So as we look at this this daily chart, nothing has changed. Like I talked about yesterday, nothing has changed in the last week. You see last Monday, sell-off here where the S&P was down, I think, over 40 points. The Dow Jones was down over 300 points. Nothing has changed. The data is the same. We haven't fixed anything. We talked about this last night. There's still currency problems. China still has problems with subprime banking, shadow banking. We just talked about the currency. The Janet Yellen's still the Federal Reserve is still gonna cut its taper QE by $10 billion a month. So come March, come the first week of March, another $10 billion gets reduced off of the QE or quantitative easing. So then we go down to $55 billion. Nothing has changed. The only thing that's changed maybe is the Congress they raised the debt ceiling, and that's great news. Is that we get to go further in the debt or accept for more. The country gets to accept more debt. It could spend more money. So nothing has changed, and again, it's all emotion. It's all technical trading, and like I said, I expect a pullback coming in. I think we're close to some downward pressure coming into this market. I don't think it's going to be the big panic sell like it was this last time. I don't think it's going to go that deep. Again, I don't know. It could, but I do think we're going to pull back and we'll be able to make some money on our shorts. Could it go up? Yeah, it could go up. Sure, it could go up a little bit more. It could go up here and kiss double top. I don't know. Again, just read the charts and stay with it. One of the reasons why I unloaded my SSO, I kind of backed my way out of the SSO trade. I sold half, I believe, on this day, a couple days ago, and I sold the second half yesterday, and I even entered in the SDS or a SPY short via the SDS at $30.30. We talked about that yesterday as well. But you can't pay up in this market, and this is what the media and the institutions want you to do. They want the average investor. They want the average investor to feel like they missed the move, to jump in here and pay up for the next leg up, and You certainly can't do that. What you need a methodology. You need some kind of discipline, some kind of methodology, some kind of system. Nobody said don't have to come use my methodology or system, but as an average investor, you need something that's going to give you some discipline to try to in an effort to take out the emotion out of trading. Because let's be real, money is emotional. When you get money, you feel happy and you want more of it. When you lose money, you feel despair. I guess if you lose enough of it, you might feel disparate and mad or angry or whatever the case may be. You want it back. So, money, either coming or going, evokes emotion, and that's the downfall of most traders, and that's why most traders don't make it in this business. They go belly up or bankrupt in a short period of time. Is because they're looking at CNBC trying to determine what their next trade is, and you have to realize or understand what the motive behind or the MO behind CNBC is, and that's to sell commercials and to gain viewership and sell commercials to advertising. To these companies, sell advertising to these companies. So they have to hype everything. They have to hype every move. Every down move has to be evoke panic, and every up move has to evoke greed. So they get more viewers. More viewers equal more advertising dollars, and that's their MO. The institutions they fall, their game falls right into this advertising thing and game, and that at the bottoms of the markets, at these lows, they want you selling so they can buy, and at the highs, they want you buying so they can sell right into you. Don't play their game. Don't listen to CNBC. I do follow CNBC for the only reason as a contrarian viewpoint. When I see those guys hyping the stock market, or I see those guys telling me that the sky is falling, I know that the pivot is near, the turn in the market is near, and that's exactly what happened back here when I jumped in the SSO right here at this trend line. I stepped in front of this market and said, you know what, the technicals are 80% right, and I'm going to step in front and I'm going to buy SSO at 91.21, and sure enough, the next couple of days is kind of a pause days before the market zoomed up here, and again I sold it here yesterday and the day before, getting out of that position. Likewise, yesterday, after Janet Yellen's testimony in front of Congress, all is well, all is rosy again, and the market is going to new highs. Let's get the new guy, the average investor, on board for the big win, so they can come in and push this market up a little higher as the institutions are selling right into them, stepping aside, getting out of this market. And you can tell by this volume. Volume trend is going down, the market is going up as large as it did or as steep as it did. That is pure institutions stepping aside and letting the little guy push this market up so they can sell right into him at the top. You can't. That's one of the reasons why you need a system. You need to get rid of the emotion, and you need a system. You need the discipline. The late great Jesse Livermore traded. I don't know when he started trading. About the turn of the century, 1900. I don't know when he was born, but he was around for the 1907 crash. 1906 earthquake in San Francisco. He was trading the market then as a young man. He traded through the great the big crash of '29 and through the depression. But one of his reasons he made millions of dollars back then, and you can think millions of dollars back in 1929 is a lot of cash. But he also lost millions of dollars, and he eventually died a broke man and ends up committing suicide because of it. And the reason why was because he broke his own rules. He got emotional in the trade, and he lost all of his money. So you need a system of trading, and obviously the system should be a good one in order to make you profitable. So enough preaching off the soapbox. Let's move on to USO. Oil had a good day. You can see it gapped up here and moved lower throughout the rest of the day. It went right into this resistance level we've been talking about for since back here, beginning middle of January. We've been talking about this resistance level. I told you I wasn't going to short it here because of this move up and this short consolidation here. I think this is a weak resistance level, but you would get a small pullback, and I think that's what happened today. However, I think USO or oil goes through this position, and my short position is going to be at 38.01 on the USO. The next move up here. And we should get that as well. Moving on to gold. Gold had a good day yesterday, kind of a pause day today. What's going on with gold? had some consolidation here, and it's moving up. Right now, I'm thinking gold's going to be a good short at 120, Pierce at 127, anywhere between 126.50 and 127. I'll be shorting the GLD via the GLL, and I said yesterday that I'd give you a good price entry for the GLL, and I'm gonna wait on that just because of the distortions in the GLL that they have to do that is inherent in the ETF because it's a 2 times ETF. It doesn't exactly correlate over more than 1 or 2 days. So I'll wait till we get closer to that point, to that short point, before I calculate an entry on the GLL. It's not that hard to do. You're just basically 2 times the move on the GLD will equal the GLL, but you can't calculate it today and expect it to be true next week or the next couple of days. There'll be some kind of distortions and decay in the GLL just based on its leverage. It's leveraged 2 times the price of gold. So I'll hold off on that. I am in IBB. It gapped up and sold off throughout the day. This is a good sign on the IBB that they may be putting in another top. I said back here right when we shorted IBB the first time, these little small doji candlesticks is a good sign, a good rounded top sign that the top may be a temporary top or short-term top might be in the IBB, and sure enough, that's what it did. It sold off all the way down to 234 from a high of 254, so 20 points on a $250 stock is about, let's see, 4% on that. So that's a pretty good move. Another indication of a top is a gap up and a sell on higher volume. I'd like to see higher volume on the IBB, more than 1 million shares. I would like to see it at least 1.5 million, maybe even 2 million on that gap up and reversal. But it is what it is, and that is it's a gap up with a reversal. So we'll see how that plays out. So I am slightly out of the money. I think I got in at 254.67. I'm not sure exactly what price. It's pretty close to this close here. 254.67. I think at 254.66 I think is at my entry. So I'm about $1.20 out of that. $1.07, whatever it is, buck and change out of the money on the IBB. But I suspect this is a good sign, and I expect this thing to move lower with the markets. So what I try to do is time my moves with the overall market. So if I think the overall market's getting top heavy or oversold, whatever the case may be, I'll start looking for either longs or shorts. So you definitely want the overall tape to be on your side, or the overall market to be on your side when you're going long or going short equities, because you don't want to fight the market or fight the tape, and that's what that's called when you go short an equity with the overall market strong and vice versa. You're going against the tape, and you don't want to fight the tape. So that's IBB. Goldman Sachs. 163 and change, 69. I can't remember what my entry price. 163 and change. I think I'm about 10 cents out of the money on this. Not very much. You see, it had a gap up. Actually, what did it do? A slight gap up. It didn't really. 11-cent gap up. No big deal. Nothing to write home about. But it sold off today. I won't even call that a sell-off. It was weak. Down 89 cents is not a sell-off on a $163 stock. So it did go down. I'll have to monitor this. You still are inside this red bar, so it's still bearish. If it does close above this red bar high of 165.52, I'll have to step aside on this. And that's the beauty of my 3D methodology is. You buy stocks where you have small stops, i.e., your risk to reward is greatest. So my stop on this is close above 165.52 or this red bar high, or I should say confirmation above that point, which is different than a close above. You have to come over to TopGunStockTrading.com and take the methodology webinar to know what I'm talking about there. But a confirmation above that level will be a stop out. So it's a tight stop, minimize my downside risk, and I'm maximizing my money making or my ability downside. I'll call it upside, but I'm shorting it. So I'm thinking the first target is going to be about the 153 to 155 level on this. So it's an $8 move, about whatever that is, a 5% move on that $160 stock. So that's the name of the game, is minimize your risk and maximize your reward there. I told you yesterday I got into Apple. However, I did make a faux pas in the Apple trade here. What I did was I put a spread. I sold a bear call spread on this, but I sold the February bear call spread, so it only gave me a week and a half or whatever it is, basically a week and a half before that thing expired. So I didn't like that timing. So what I did was I got out today flat. I paid enough for my commission there. No harm, no foul. I'll look to I'll reevaluate this Apple trade a little higher, maybe at 542.72 is the next level up. We'll reevaluate there, and if it looks good, we'll take the trade there. But a rookie mistake on my part of buying the wrong month spread there. So again, we'll look to re-enter that trade when the price is right, so to speak. All right, just a quick recap. SPY into resistance. It did fill the gap here. If you can see the gap, I don't know what day that is. Sometime in January. I filled the gap right here on January 23rd. So good resistance in these parts. Okay, I got my next resistance level is at Pierce at 183, which is basically a gap fill there. So again, we can go sideways for a while, slower, shallower channel there, and we'll look to go up for upside there. If we do that, if we do go shallow sideways down, I'll look to exit my short positions and short order and look for long trades. However, if we get a more steeper pullback, again, we'll look to exit our shorts and some point in time go long there. But both scenarios, it's going to be based on time and then the pattern that is putting in for the spiders, depending on how when our next move is coming from. All right, folks, you got to keep the emotion out of your trade. You got to have a system. Come on over to TopGunStockTrading.com, and we'll teach you the Top Gun, the 3D methodology. All right, folks, I'll see you tomorrow.